Hello, everyone. Good day, good morning. How are we doing today? It's a real pleasure to have you join us. I can see we have a number of participants just joining at the moment, and we're just going to give it a few minutes. Hi, everyone. Here we have more participants coming. Just going to give it, okay, 2 minutes, and then we'll kickstart the webinar. Thanks. Hello again, and welcome everyone to another one of our capacity building webinars. Thank you so much for making the time to join us today. It's really amazing looking at the turnout that we've gotten and the support that we've gotten for the webinars, which is an initiative that we launched last year to tackle various issues around the energy space in the Southern African region. And it is Okay, just looking at the numbers, we're over 100, which is amazing, and we shall kickstart shortly. There's perhaps a few admin issues. The chat will be open throughout the session, so please do feel free to engage via the chat and the Q&A section as well. So please do throw your questions in the Q&A section while the presentation will be going on. We're going to have a 5-minute break after an hour as we dive deep into the discussion. Of course, we're covering financial modeling today, and it's the sixth session in our webinar, which the recording will be made available to you after the session on our YouTube channel. I'll share the link in the chat, so look out for that. Thanks again. I'm already seeing some questions in the Q&A section. Yes, we will make the recording available, and this session will be handled by our CFO, Johannes. And without taking much of your time, I'll hand over to you, Johannes. Thank you.
Perfect. Thank you so much. And thanks everyone for joining. As mentioned, we want to focus a bit more on financial modeling, and it builds on the previous webinars on project finance and other elements during the IPP development stream. The rough course outline is that we start with an introduction, giving a bit of an overview and focusing then on why we need a financial model, what are the key components in a financial model, the financial structure, the debt and equity element we'll touch a bit on with some key ratios. and hopefully have a bit of time for some best practice tips and guidelines, and scenario and sensitivity analysis. And thereafter, there will be also Q&As. So as Jehoshaphat has mentioned, feel free to type your questions in the chat. I will try, if possible, to answer them during the presentation, but otherwise after the presentation during the Q&A. We will, I think, roughly take 2 hours. So, and with a short break to allow a glass of water. We have mentioned the admin parameters. So thanks so much, Jeho, for facilitating. Yeah, if there's any admin or technical issues, please post it in the chat, and Jehoshaphat will take care of it. Yeah, let's dive into what we want to try to achieve. I mentioned the course outline and the rough ideas on timing, but maybe to share some thoughts of what we're trying to achieve in this webinar. I think financial modeling is a very interesting field, and it takes a lot of course, Excel and technical skills, but also understanding of the overall project finance structure. We will not be able to turn you into great financial modelers in these 2 hours, but I would like to give you some key highlights, best practices, tips, that you at least can spot a good financial model, can see what is required, and helps you to understand where a financial model sits in the overall process. We will touch a bit on financial structures and project finance, but of course that's another topic in itself. So we're trying to give an overall summary, and hopefully you find it useful. Maybe 2 sentences about myself. I'm coming from the banking background, focusing on infrastructure finance and financial modeling. Worked about 10 years at KfW, the German Development Bank, in a specialized team with other financial modelers, and we were responsible for all the cash flow based and project finance structures. So I've seen a lot of models, analyzed them, and did the quantitative risk analysis. I'm happy to share some insights there. But yeah, since now many years, fully focusing on Greenco, and happy to share my thoughts here in that webinar. You have seen in previous webinars where we touched on the project finance structure and the legal structure, that project finance is highly complex, not only from a financial modeling side, but also from a legal side. Meaning we have a lot of counterparts, a lot of contractual arrangements that need to fit together. So that's important to understand, because these contractual arrangements also have to be then reflected in the financial model. And that's why I personally find it very interesting. As a financial modeler, you of course dealing with a lot of numbers, but you also need to understand the commercial background if you want to be a good financial modeler, that you understand the sensitivities, the importance, and but you see a lot of the economics of a project in the financial model, because everything has to come together. I'm not focusing here on these legal and contractual arrangements, but just wanted to give you an overview that there is a lot, and this is only a snapshot of the contractual arrangements and the legal work that is also required in a non-recourse project finance structure. So let's focus on the question why we need a financial model. Financial models are, of course, existing throughout all industries and all financial structures. We're focusing here mainly on project finance. Project finance is a sector in the banking industry which is highly requiring a financial model, because we're talking here about cash flow based non-recourse structure. Non-recourse means the bank, the lender, and also the sponsor really looks at the project itself, and the project itself has to repay the debt and the investment. And therefore, it's crucial to really understand the risk, the cash flows and profits that are generated by the project over the next 20, 25 years. So the financial model is a key element in infrastructure finance. Um, the financial model is a tool for various stakeholders. So, of course, as a developer, you need that. You need that early on to assess the feasibility, get an understanding of the economics, and at some point, then when you move towards financial close, equity raise, but also then financial close and debt raise, it's a very critical component for the lenders to assess the risk, to run sensitivities, and to structure the financing that suits best the project. But of course, also these models are used for regulators and governments if there are regulatory questions about feed-in tariffs or other calculations or approval of PPAs. And therefore, there are these different models that are focusing on these different stages from feasibility. Then there could be also more technical models where a lot of technical input is required, and then of course the financial part. But even after financial close, operational models are required for updating the numbers and the performance of the project. And maybe at some point there will be refinancing, evaluation, or mergers and acquisition model. That doesn't mean that there's always completely different models, but they sometimes serve a different purpose and they evolve. I think one key lessons learned I would like to share is a financial model is a living document, and a document that sometimes over many, many years exists. And that's also why I will touch a bit on best practice, how to make it robust and to survive many, many years. Um, However, it's always important to ask ourselves some key questions when we build a financial model or work on it. What is really the purpose we want to achieve? As I have indicated, there are multiple phases or stakeholders. Who is the audience? What message I want to bring across? What is my key risk I want to analyze, or my scenarios? What granularity I need at which stage? Overall, I would always recommend to start with a monthly model. That is usually the best to then also survive any further changes through the life cycle of a model. But it might be that very early on you start yearly on a very rough model, but at some point you will need to have a monthly model. Why this question is so important is changing a yearly model into a monthly model takes a lot of time and potentially a complete rebuild. So understanding what is my granularity, what is my time frame, do a model 5 years, 25 years is very crucial. And it's usually best to start a bit more granular and a bit longer because that saves you a lot of time. The other element is also to understand the economics when you model, meaning what are the key drivers, what are the key sensitivities of a model, where do we need to focus our attention to, and here in that little box you see the kind of a basic formula on your profit. You have your price, you deduct your variable costs, you multiply it with your volume. That's, for example, megawatt hours in the energy sector, and then you deduct your fixed costs, and this determines your profit. And depending on the project, renewable energy is one part, but of course we can model mining, you can model infrastructure, transportation. Some of these are more variable than others, and it's always important to understand what are the key drivers and risk. Just checking if there's any technical issues, but I think we are good. Um, and that also, of course, leads to the questions: what are the key outputs we want to provide, we want to present to the audience? We're now diving in a bit into a very high-level overview about the key components of a financial model, meaning what are the key inputs, outputs, the structure, what elements to consider. I'm giving here really a high-level overview. Of course, we have renewable energy projects in mind as the key focus, but we will not be able in this presentation to give you kind of assumptions. What is the average capacity factor? That is highly dependent on the structure, on the technology, on the location, and other parameters. So one thing is, before we dive into modeling, um, modeling further elements from the financial part, it's really crucial to understand what are my technical parameters, what are my revenue drivers, what is my generation, how I can determine the volume in our formula. Meaning, what are the timelines in terms of construction when we achieve COD? What is the lag between? What is then, for example, the capacity in megawatt? What is the capacity factor of my solar plant, wind farm, or other renewable energy projects? What are potential losses? Do I want to model monthly seasonality, degradation, and other elements? So these are questions that stand very early in the development stream and also in the financial modeling work stream, to understand what is my expected net energy production per month or per year, because the volume, of course, is a key element. All these parameters will be refined and changed and optimized during the process with technical studies and simulations. But to already have this concept of these key parameters and inputs that drive my volumes are key. The other element is then costs. And we have of course, EPC costs, the construction costs. What are the costs, and also the schedules? When do they occur? Do I need to pay everything up front on a monthly installment or at completion? What costs lie before we actually start contracting with an EPC? Meaning, what amount of costs are coming and need to be maybe built into the model in terms of feasibility study, all the years of work, securing the land, and so forth. And that's in general a cost component that cannot be underestimated, because sometimes, yeah, project finance takes a lot of time, and a developing project is not something that can be done in a few months. So there are lead costs, and it's also important to have this factored in your business plan when you start looking into developing a renewable energy project. Of course, grid connection is a critical question and also a critical cost component. What are the costs to connect the project to the grid? Do there need to be some improvements on substation? How far away is the next substation? What is the line? That's another key cost and component. And then we're coming to financial costs. The interest during construction, or IDC, are important, because especially with long construction timelines, you're paying interest on your loan during construction before you earn any revenue after the project is operational. And there are also upfront fees, which could be quite material, and other due diligence costs during the financial close process. And then, of course, working capital, O&M, question of VAT, and duties are an important part. We'll touch on tax in a second. That determines then the total project costs, meaning what I need to secure funding with equity and debt. That's then the goal, to get an understanding to how much equity you need, how much debt you need. Now, well, once we have determined that, we are moving a bit more into the revenue part. In the previous slide, we touched on the technical parameters to determine how much megawatt hours, for example, we generate. But now it's the question: what is the revenue? What is the price? What is your PPA structures? What is the tariff looking like? Is it just per kilowatt, per megawatt hour basis? Or is there some capacity charge? How long is the PPA? In which currency is the PPA? Is it indexed with CPI, with a fixed indexation, or is there no indexation at all? What happens about deemed energy? What is about potential merchant risk, or revenue? With Greenco, for example, we offer the ability to allow developers to participate on the market and get some upside or downside from the market price as a proportion of the PPA. So that can be as an individual discussion. And of course, renewable energy certificates or carbon credits become also a crucial part, another very complex field in its own. But at some point, that these parameters should then, together with the volume, create what is your top line, what is your revenue in a financial model. Before we come then to the debt service, financing costs, equity, we need to look at the O&M costs, meaning what are the running costs for your operations and maintenance costs and your contractor? What are lease costs? Do we have to factor in maintenance, replacement? Do we maybe need to put money aside in a separate account that in 5 or 10 years some inverters can be replaced? What are overall admin and SPV costs of that project company? They need a bookkeeper, they need a director, then they need also some sorts of general administrative costs, which overall should not be the biggest component. It's mainly here, I think, the O&M costs, but these things have to be considered. And in renewable energy, we usually don't need to model fuel costs. That's the purpose of renewable energy. Of course, when we have concepts like biomass or waste to energy, then this is different, and that's another then also very complex modeling stream about fuel costs. But usually, renewable energy projects are on this side quite straightforward. When we have determined our operational costs, which could be consists of mainly fixed costs, but to a certain degree also variable costs, we come to the question of revenue, profit, and then taxation. Tax is also a very big element because the tax rules, of course, are very complex, differing from country to country. The question of special custom import taxes is crucial. What is your depreciation method you are allowed to use for tax purposes? And what are potential other withholding tax when you pay interest or dividends? How is your dividend policy? How much can you actually return back to investors and stakeholders, and what are other benefits certain countries maybe give you? And then after we have determined this, we can look into the question of the overall financial structure. And that's a topic in its own, and I think we touched a bit on our previous webinars, but of course the financial model needs to reflect this, and this can get very quickly very, very complex. While overall project finance for renewable energy is straightforward, but the devil is in the detail, and each project is a bit different. It always starts maybe simple, but in the end it could be quite complex. The key components are, of course, equity. As you might know, non-recourse means there's no recourse to the to the investors, meaning they need to inject some money and commit these funds. But on top of that, usually there's no further commitment. And that's, again, one reason why the banks especially look very much into the financial model, the risk of the project to repay the debt, because usually there's no ability to go back to the investors and say the project has a problem, please pay in another 10 million. But the equity itself can be structured in multiple ways. It can be pure equity, it can be a shareholder loan that's sometimes used for tax efficiency. Also, the question is, when does the equity come in, at the beginning or pro rata? Usually debt doesn't come in first, so it's definitely that the equity goes in first, but to which extent is of course a negotiation and a discussion with lenders. There could be some premiums being paid out at financial close for the previous developer, or if a new developer takes over, or to pay out and compensate for some of the upfront costs. The the debt is a key component in a renewable energy project. Mainly the revenue will be used to repay the debt, meaning renewable energy projects are very capital intensive. This is the key driver for the required PPA. And the debt has multiple key parameters. As I said, devil is in the detail, but one key part is the tenor. Are we getting a loan for 10 years, 15 years, 17 years, or even shorter? What does it then mean? Does it mean it needs to be refinanced? Usually, we need long tenors to repay the debt. But of course, access to dollars in some markets is difficult for 15 year. Therefore, we see a lot of development finance institution providing these. But it really depends on the market, on the currency, how long banks are able to give loans. And then the question is, how are these loans repaid? Is it a straight line and annuity, or usually what you see is so-called sculpted profile that achieves a certain debt service cover ratio? We'll come to that in a second, or in a few minutes. Therefore, I will not dive into that into more detail. And of course, the interests are key, and the interest environment, and the margin and the base rate. So the interest costs are usually split in two. One is what is your base rate, and what is the margin for the bank. Usually, the base rate is then structured as a swap, a hedge that allows for the 10 years or 15 years of the loan to have a fixed interest rate component. So the interest is therefore known. The question of gearing, meaning how is the proportion of debt versus equity? So meaning, is the bank willing to finance 70, 75, 80, or maybe even 85% of the project costs, and therefore reducing the need for equity? I think to start conservative, I would usually start with a 70-30, but depending on the market, 25-75 is potentially also a starting point. And there could be also element of cash sweeps, more flexible repayment structures on top of a fixed repayment profile. But this is then already going a bit deeper into financial structuring. And the other element is reserve accounts, debt service reserve accounts, debt service reserve facilities. These are also key points to consider. And of course, there are much more other structures that maybe sit together in a financing structure of a renewable energy project, but this is a case-by-case element. I touched a bit on then financing structure parameters, meaning there's something like debt service cover ratios, a key component which we dive into in the course of this webinar, and what are the drawdown or order repayment seniority if there are multiple debt tranches, and what is the overall debt capacity, gearing, and the tenor. These are then key financial structuring parameters. Another element is then to look at when we have built all of that, how we present these results. A financial model modeled monthly over 25 years has a lot of column, thousands of rows, and we have to summarize these for the various stakeholders to also understand the impact. And the most straightforward elements which always need to be in a financial model are the financial statements. So that's a cash flow statement, um, a profit and loss statement, a balance sheet that all need to match. So that's a key part when you build your model and make sure that all of these parameters fit together. Then you have already achieved a good step. Because of course, yeah, from an accounting perspective, they need to speak to each other. You can't have a mismatch and some unaccounted flows. You want to have these financial statements monthly, quarterly, yearly. It's always good to start monthly, then you can more or less easily aggregate into quarterly and yearly. We always have to keep in mind that some stakeholders have not spent 150 hours on that financial model. They want to see within a few minutes high-level numbers. They maybe prefer yearly, while the financial modeler working hundreds of hours on this model, of course, needs to dive in deeply into the hourly granularity. One key part is really also the cash flow statement. We are here with financial models mainly speaking about cash flow models. So for us, the cash flow view is quite important. And there's a cash flow statement principle from an accounting perspective, but there's also a concept that you can say cash flow waterfall, which is very intuitive from a cash flow perspective. That means what is your top line? What are your costs? What is then paid maybe in taxes? What is then going to the lenders and the debt service interest and repayment? What is then going to sponsors or your cash balance? So that's what we call a cash flow waterfall. And that's a very important thinking when you look at a financial model. Now, financial models are not designed to replicate your balance sheet in perfect way for the next 20 years. It's really the cash flow view that is crucial for these projects. And then, as I said, you want to summarize all of this in maybe even more aggregated form in an executive summary, some key outputs, key ratios, a graph, a table, some scenarios, some high level 1 or 2 pager to present also your project to stakeholders to get interest. And the executive summary, therefore, is quite important because that's sometimes the only thing what people see and want to see and look at. And some of the key ratios need to be also included there, and we dive into that in a second. What are CFEDs, debt service cover ratios, LLCR, PLCR, loan life cover ratios, project life cover ratios, and of course equity IRR or project IRR. So these are key ratios in project finance that should be presented on the executive summary because they give a good understanding of where the project is in terms of financial robustness. Speaking about CFEDs, so this is one of the key ratios, key parameters, outputs you need and want to calculate. CFED stands for cash flow available for debt service, meaning we're thinking again of our waterfall. What is the cash that is available for the bank to pay interest, to pay repayment, and pay back the loan? And this becomes for the debt service cover ratio in a second very crucial. There are different ways how to calculate CFEDs. There is the kind of more accounting way coming from a net income, adding back depreciation or working capital, interest expenses, and so forth. That's more maybe sometimes how cash flows are represented on an accounting side of view. I'm definitely much more in favor of the first more direct route, the cash flow waterfall route. What is your EBITDA? What you have working capital requirements or taxes, and then you come to CFETs. Of course, it's a science in its own. What is going into CFETs, what is not going into CFETs, what is deducted or not. There's each bank might have a slightly different methodology, and there are some edge cases. How do you treat um, reserve accounts? Meaning, if you have to put aside money for maintenance reserve, is that part of the CFETs or not? And these are then case-by-case decisions and discussions. When we have our CFETs, we already have achieved half of what we need for the debt service cover ratio, the key financial structuring parameter in project finance. That means the debt service cover ratio is the CFETs, what is the cash available for debt service, divided by the actual debt service. And that gives you a ratio, meaning you have $1.5 million in 1 month and have to pay 1 million to the bank in interest and repayments. Your debt service cover ratio is 1.5, which is a good cover ratio for a renewable energy project. You will come to some numbers in a second, but it's roughly 1.2, 1.3, depending on the case. So this is the absolute key structure, and usually what you see also when you ask for indicative pricing or an expression of interest from a bank, there's always the question, okay, we are willing to finance with this tenor and this gearing, but we have to achieve a minimum debt service cover ratio of X. And even, yeah, the repayment profile might be built around this structure. And this ratio is also used to determine, can you pay dividends or not? Do you have a lockup? Do you have to do an extra repayment, a cash sweep to a bank to determine this, and using that as a trigger also for event of defaults and lockup periods, as I said. Debt service cover ratios can be calculated historically and forward-looking. Most likely, the bank would like to see both. And it's always the minimum that is very crucial, but also, of course, the average. Overall, we want to, of course, avoid that there's ever a ratio that is below 1, because that means in that period, you actually can't pay the debt. So the minimum cover ratio is very crucial, and then it starts to really then to in the financial engineering and modeling that you smoothen out as much as possible your debt service, and we come to that in a second when we speak about sculpting. Another key ratio is the loan life cover ratio that uses also CFETs, but looks a bit more holistically at the future repayments and the future debt service. So that ratio takes the NPV, the net present value of all future CFETs. NPV means the future cash flows are discounted in a way. And again, question which discount factor to use. Usually you use the discount factor of the interest rate as in from your loan. So you discount, therefore, your future revenue or CFETs and divide it by what is the current outstanding debt. That gives you a good high-level, robust number about the overall cover ratio, not only in this next 6 months or 3 months or year, for the remainder of the project. Yeah, because it answers the key question: does a project generate enough cash flows during the loan life to repay the debt? So it needs to be also above 1. The slight change is the PLCR. So the LLCR takes only the CFETs during the loan life into consideration. The PLCR takes the cash flows and CFETs for the whole project. So, for example, usually a PV plant has an assumed life of 25 years. Even if in reality, we hope these panels last much longer. Yes, they degrade a bit, but of course, you still have a lot of asset there. But usually, banks take a 25-year view, and then you discount for 25 years. Therefore, the PLCR should always be higher than the LLCR, because if you're taking CFETs for 25 years, that should be always much higher than for 15 or however your loan life is. There's more details how you calculate this in terms of what you do with your debt service reserve account if you have put cash to a side to cover for for any issues. This can be also taken into account for the benefit of the project. Here we have a snapshot of an executive summary. We might have a bit of time just to go into a live model to more or less when we finished our best practice session, to just maybe showcase some of these elements also in a live or in a demo model. I'm not starting to model or doing some big changes, but so you can see a bit what I meant when I speak about certain elements of best practice and design. So here we have this executive summary, and this is here an example from our model. But the idea is that you have a 1 or 2 pager that gives a yeah, good overview. This is my way how I do it. It doesn't mean that's the perfect way. It's just how I have seen a lot of models. They usually have the sources and uses, meaning what are my project costs in a table? What are my sources? Where does the money come from? Needs to match. Then you have a chart showcasing your CFETs and your repayment and interest profile and all the key ratios we have discussed. Then annual cash flow summary, for example, could be quite interesting, and a more detailed ratio section. So that could be one part. We are now moving into best practice. I maybe take a second just to see if we have any immediate questions, because I think we're good on time. Let me see if I see anything. Yeah, maybe we can go to these charts on the executive summary, because I've seen a question there, but kind of maybe have answered that already. There are, of course, all sorts of charts, and we will go into also something like called a tornado chart that addresses mainly sensitivities for certain parameters for certain scenarios. For me, I found this CFETs chart quite helpful, because what you see here is that gray area is showcasing your CFETs, your available cash flow, and then the green bars showcasing what is your repayment proportion, what is your interest, and resulting from that relationship of the bars and the area, you have the ratios, the debt service cover ratios. Here you see they are flat, because the repayment has been optimized to exactly achieve this number. So that's why you see that in a flat way, but otherwise it can be also fluctuating a bit, but it gives a key first impression of that project. You can have some pie charts if your sources are a bit more complex, to say, okay, I have 25% equity, then there is a mezzanine structure, then is debt, senior debt 1, senior debt B. Then you can also do some pie charts. You can be creative there. I assume the internet has also some examples where you can have a look. Okay. Maybe jumping back and trying to touch on LLCR a second. So you have your CFETs on each period. Yeah, what is the cash flow available for debt service in this half year or this month? And then you have to discount them with a certain discount factor. For example, 8%. When that's your debt, your interest on the debt, or six, or whatever it is, and then you bring them forward to a net present value. Yeah, because cash flows that are far in the future are not as valuable as earlier. So you're creating an NPV. I think NPV you're hopefully familiar with. Otherwise, please feel free to look it up. And then you have this one number, and you compare it now with the outstanding loan balance. And at this point in time, you can calculate the LLCR throughout, yeah, depending where you are. So you have, for each month you have a different LLCR, for example, because your numbers and your timing are changing. But you compare it with the outstanding debt. Um, and the reason why we discount is more or less because the outstanding debt, of course, attracts an interest rate, and the discounting is therefore kind of taking care of this. I'm not sure if that's more clear. We can see if we maybe have a look in the model. When it comes to the question of at which stage in the development cycle you have to develop a financial model. Um, I'm, of course, not an expert in IPP development, meaning I have only a rough idea how long it takes, what needs to be done. But for me, it's quite early. You should start having a financial model. Um, but I feel sometimes there is too much focus, or that is on land, to say, oh, I have some land, I build a solar park, fine. Yes, you need land, you need good land, you need also good resources in terms of meaning the right wind or solar resources. But you also then really need to see that it's economically feasible and competitive, meaning what are my EPC costs? What do I think I can, what are my construction costs? What are my grid connection costs? And you would need to start to put these numbers together to get an understanding, what is my tariff I require? Yeah, and of course, then there are a lot of assumptions on what are my debt costs, my financing costs, what is my interest I can assume. A financial model should always be able to, or as I said, will be updated. You can always start with some assumptions, and then you have to refine and have to reduce the error of margin. But I would start very early to get an understanding of your key commercials. That doesn't mean that all the details need to be in a financial model. Again, it's a living document, but I'll try in the best practice session to show you what are the key cornerstones and foundations you should consider to make it adaptable but robust enough to build on it, because its financial model will be developed over years, because you start maybe simple. Um, with assumptions, and then you refine, and when you then go into in the financial close and structuring, you might also need to potentially procure experts, but of course then maybe the financial model can be used or needs to be rebuilt. But then, so it's a process, and the key part is building it in a robust way that you don't have to restart over again. Um, so maybe we move a bit into best practice, and then we can see that we have a bit more time on the model and also more Q&A. So now let's speak a bit about what are key best practice recommendations from my side. And as I said, this really helps to build a good foundation, so you can work on this model for years and step by step optimize it and improve it. One absolutely key rule is one row, one formula. That means you have one formula which you track across all your timeline, through your timeline. Usually in project finance, you have on the columns is your timeline and the rows are your steps of calculations. But you need one formula that is built robust enough with the dollar signs to fix references that it can be tracked across. Otherwise, your model will fail 100% because you will not have a chance to audit it because an auditor would then need to go into each individual cell. And the risk of errors is so high that there will be definitely errors and potentially very big ones. Because we are speaking here of hundreds of columns. So your financial model extending multiple screens to the right. If there's an error somewhere there, it's very, very difficult to spot. So that's an absolutely key rule. And I can show that in a model. The other key rule is to separate inputs and hard-coded values from your formulas, meaning all inputs need to be consolidated in one or two places. Meaning everything what you change in terms of assumption, you type in one sheet, and that's also then easy to track and to change. And everything else which flows into your model is linked purely with formulas. So if you have a special, for example, you're saying, in that construction period, maybe you do it yearly, we are done after half a year, and therefore I type then in my formula, in my calculation, divided by 2 or something. That's a problem. Yeah, it breaches the one rule, one formula assumption. And it also, if you type in hard-coded values in your formula, plus 1,000, that's not great. Take the time, make a proper input sheet, put in your assumption, and link it, and then you can work from there. If a model gets very large, you might have multiple input sheets, but in the beginning, one should be enough. Another key part is to then format the inputs appropriately. In my models, usually green, a light green shaded box means this is an input. This is a number you type in. Otherwise, it's a formula you should not touch. You can have a look, but should not change. You should only change the inputs. The other part is what I highly recommend is integrity checks, error checks. There are certain numbers or certain sums we know always have to be zero or always have to match. If you do a monthly sheet and a yearly sheet and a quarterly sheet, the total sum should be always the same. And it's very important to just do a little check that says this needs to be the same than this and this. Otherwise, make a flag, make it red, because that helps you to spot errors. This is one of the key quality controls you would need. I've mentioned that cash flow statements, P&L and balance sheet needs to match, meaning your retained earnings from the P&L needs to go into the balance sheet, and the cash balance from your cash flow statement also needs to go on balance sheet. And of course, the balance sheet asset and liabilities need to match. So that's very crucial as well. Another key part is circular references are not tolerated, not allowed. I would stop using and looking at a model if there's a circular references. Sometimes the circular references, if they depend on something, and that's especially with tax and something, is a bit tricky to solve. You have to then see if you sift your periodicity and look at the previous period or something. Otherwise, there are also simple copy and paste macros, especially on financial structuring when you optimize certain things. But therefore, always switch on the or switch off the iterations in the calculation tab of Excel. So you get a warning if there's a circular references where something is referring to itself, and you have to fix it immediately, because otherwise it can become very tricky. Just going into the data validation a second, and then maybe look at the Q&A again. The other one is data validation. That means if please feel free to use the data validation feature with a drop-down list, because it limits the inputs, and especially if other formulas referring on this just narrows it down. And if there's a typo in your inputs, then otherwise the formula will break. And if you want to extend the options to use, you can always use it in the drop-down list. I'll have a quick look if I see anything further. Okay, let me continue with another key part that should not be underestimated. That's the simplicity and the user friendliness. While I was always saying financial models are so complex, and it's still something we want to build them as easy as possible. Meaning they should be not complex. They should be straightforward. They can be very detailed, meaning you have a lot of of steps in your calculation. A plus B minus C. You can have as many rows as you like. Excel is endless. You have enough space. Don't try to calculate too much complexity in one formula, because that's another part that allows you to, if you spell it all out in individual steps, it's very easy to follow, to understand, to check, and to then enhance going forward. If you have each step laid out and you then realize, oh, you have to do an adjustment and some more details, you can slot in another step. But if you have one big formula, I'll show you some examples. You will be lost very soon, and the risk for errors is very high. Therefore, very short, simple formulas. Yeah, could be literally A plus B multiplied by something. That's it. Yeah, it does not need to be fancy, and rather have multiple steps. Also, the formatting is quite important to just create structure and clarity. And as I indicated, to really differentiate what is an input and what is a calculation. VBA and macros should be not used if possible. There are certain elements, yes, where you might need them, but let's not create black boxes. An Excel model should be very transparent and easy to read, and not a magic button that does a lot of things. That doesn't mean that you can build a proper professional model without a macro, but it should be really minimized to the core. Another part is the model structure in itself, how a model is built. So meaning, how does data flow? So we have inputs, color-coded correctly, moving to calculations where things are happening, all the detail and the magic, and then a summary, an output and results, and then your executive summary. Yeah, so this is helping to structure the flow of data, and to a certain degree sometimes helps also if the model is structured in that way. I sometimes still do it differently, where the executive summary becomes the first step, but otherwise it's helping me to also replicate that in your tabs in your structure, and I will show that in a second. So this then is, for example, a structure chart in a bit more detailed way, like where are all the inputs coming from, how many tabs you have. You have elements of your flex and timing parameters. I will show you that in a second. Then you have maybe a tab on construction, a tab that focus on revenues, a tab that focus on operations. Then there could be tabs on the pure debt modeling, the assets, and then moving into certain technical sheets, checks, summaries, ratios. This would be already a quite complex structure. In my example, it's much more consolidated and small, but a big proper financial close model is quite complex. And another element is the model structure within sheets. Um, so we have spoken about how a model in its tabs with its tabs should be maybe structured to have it clear. But how can you also then make sense of a structure within a tab within a calculation sheet? And one part is always there should be a mainly from input to the steps to the results always downwards. Um, and if needed on also on to the right side. And another part is if you're pulling data from another sheet, try to pull the data into this box in that tab and then take it from there and not linking it always directly too much to external. And I'll show you that in a second. So this is an anti-best practice example. So apologies, it has a bit of German in there, but you get the idea. Um, that's a very long, complex formula. And even a professional financial modeler would need to sit there 15 minutes to understand what's going on and still not sure if it's really working in all cases. And these projects are usually these are very difficult to audit, very difficult to maintain. Imagine you receive from your president, from your colleague, a model like this, and say, "Here, it's all fine. Have a look," and you need to then put another if statement there. So meaning make a lot of different side calculations, a lot of steps that helps to spot errors, to keep it granular and robust and simple formulas everyone can understand within 10 seconds. That's a key advice. Here we now see a bit how that looks like, and we can look into our model in a second. There's always usually something like a header that gives you some information about what is your life case, in which tab I am. Then I found it very helpful to have a fixed timing and flag section that always is repeated throughout the model. Each tab has this in a standardized way to really showcase, okay, are we in a construction phase, operation phase? Year one, year two, which quarter of the year, you always need these parameters. At some point, I can ensure you, you always need to know, for example, how much days in that month we have. Yeah, so that's something it's always good to calculate in one place and not always recalculate in each formula. So we have space, let's make it nice and clean, and we can always use grouping functions to hide it, to not avoid and distract. Yeah, and then the key part of the calculation comes, and we will touch in a second a bit on labeling and formatting and how then the body of the calculation can be structured. Yeah. So here, for example, what's very important, having good headers, good description. What is really the line trying to achieve? How give it a proper name? What are the units we're talking here? Yeah. Do we need any side switches and calculations, which we use from other sheets that then translate into my calculations? Because otherwise you have to always do the side calculations in the formulas. You want to maybe do it once and then just link to it. And what is crucial is also to create summaries. As I said, 25 years, 12 months, that's a lot of rows. You need always a summary. What is your actual total value? So you can spot errors, you can see if it's plausible. And then you have your formulas with the very famous, very important one formula per row rule. So meaning you build one formula and it needs to be tracked throughout. So literally you should be able to copy column J here in this case and copy all the formulas completely throughout the model, and it should not change. That's a good test. If it changes, then there is a problem. Before we go into further financial structuring, I think we maybe take a 5 minutes break. I think overall we are good in time, so we can spend a bit of time in the model where I'm more or less just trying to repeat what I've presented on the slides, and then we have more time a bit for other elements and Q&A. So would say let's take a 5 minutes break and see you in a second. Thank you. Okay, I think we will continue. Maybe as a little summary, what we have covered. We were focusing on why we need a model, for which stages, and what are the key components we have to look into. What are the key ratios we want to calculate, and what are some key best practices and structural advice or tips we would like to give you. And we switched to a template model of Greenco just to give you an idea about what is required, or what helps you in building a model, and maybe saves you time. Overall, I think it's very important to not try to do shortcuts and take the extra minute, because it saves you multiple hours potentially going forward. So we will more or less refresh a bit the best practice element on a live model, and to so you see a model not in action, but you see a model how we build it. And then we focus a bit more on some financial structuring, some elements. This goes a bit into details that is relevant then for the financial optimization at the financial close process. I strongly advise that there might be the need to get an advisor, financial advisor that supports you in that process when you are closer to financial close, to the engagement with the banks. Because the financial optimization is challenging, and if you do it for the first time, it's potentially um, not sufficient for the lenders. So we'll do that in a second, and then go a bit into scenarios and other outputs, and moving into Q&A. I would expect another 45 minutes, so we'll stick within our 2 hours. Give me half a minute to switch and plug in my laptop, and then I'll be back in that 1 minute. Okay, I hope you can see my screen again. We are now just looking at here a template model. Again, it's always the question, what is the purpose? Here we really have a template model that is quite light touch on operational details, because it's acting as a template, and it's focusing more on financial structuring. And we used that for some analysis a while ago. You see, it's going back to 2017. The first part is, yes, we're starting here with the executive summary, but as I've mentioned, from a logical data flow, this tab actually should sit here on the right-hand side. But as it's the entry to a model, sometimes I decide to move it in the front. We will come back to the executive summary in a second. Here we see the input tab, meaning, as I described, trying to put all the inputs in one place. So we're having clarity, what are the driving inputs. So that sheet can have a few hundred, up to 500 or 1,000 inputs. You can have multiple sheets if required. And one part which I want to jump right now in is, for example, design template or style guideline. You see, there are certain clear structures, how certain headers or assumptions are labeled. So standard assumptions here is green, then we have something like an off-sheet reference. So an input that comes from another sheet has a different color. Hard-coded cells or technical inputs have a different color, checks, and a clear understanding how our units and formats and ratios are done. These having also, 1 second, having here using cell styles, so you can predefine this. You don't have to always copy formatting. You can just click a cell saying this is now an assumption, and then you automatically have the right number, and you say, okay, this should be now a factor, or it should be percentage, a ratio, and so forth. So that helps to make it easy to use, clear, and visible. You can use the grouping function. I highly recommend that to summarize your model and condense it. So you then can go into certain elements. Okay, what are my interests and fees? You can open that and you see, yeah, there's a lot. And you can have these inputs here and therefore get clarity in your structure by using the grouping function. And with proper headings and sections, you can make it easy to navigate, even if your model is quite large. These tabs have also different colors. We then have here something scenarios that also have inputs, but here we have a scenario manager, and we dive into that in a second, that you can set up certain cases where multiple sets of inputs are grouped together, and then there's an easy toggle, a drop-down menu that allows you to switch between these. And I think we'll have a section on the scenario manager going forward, but that gives you the ability to flip between certain cases, equity case, lender's case, downside cases, and you then can also calculate scenarios. And here you see, for example, there are some buttons which have macros, so that's okay. And then you could have your calculation tabs. Here we have here construction and operations in one. You see that we have our header and timeline with so-called flags. That just makes it very visual to see what is your construction period, what is your operation period or PPA period. And these stay always on top with using the functionality to freeze panes. And then you could have your section with your labels, with your units, maybe the summaries. Here I use some functionality that I compare my live sum with my hard-coded case, or maybe a reference case. When I click here, the current case will be copied in here, and I see the difference. And therefore I can see what changes from some version to another or from one case to another. And then the model starts to go to the right, and it goes a long time to the right. So this is the golden rule, one formula, one row, because if you have a change in here and make a +10, you will never spot it again. You see already there's some errors coming up because the model sees that there is a problem. Yeah, these are certain checks. For example, here's a check. Yeah, with cash flow statements, are these numbers matching? Is there a delta? It should be always 0. Otherwise, that flag goes on, and that flag is then linked to, for example, to a check system that here sits at the moment, for example, at the input sheet, puts it also in a technical tab, where you just have a look at all your key signals and checks you want to always monitor, and it immediately flags up if there's something that is potentially not intended, a key quality control feature. Then you have further calculations on ratios here, especially the cover ratios at some point become very crucial. Debt service cover ratios, LLCR. These are then quite complex. They have to align with the periodicity of your loan and require a section of its own to calculate these. When is your first ratio to be calculated? Do you want to group that annually, quarterly, backwards, forwards looking? That's something that is requiring enough space. As I said, we have enough space. You can create multiple tabs, you can create multiple rows. And then here, for example, we have the loan life cover ratio, where we have our CFEDs per period. We then have a flag to say when we always want to calculate the CFEDs. What is my discount rate? What is therefore the NPV for my future CFEDs always added up, cumulative? How I maybe treat a reserve balance. So if I have cash set aside, that should be part of this calculation. So that is what is my nominator for the LLCR, what is my outstanding debt balance, what is my ratio, and then what is my minimum, what's my average, maybe when I calculate the ratio. And you see, these are usually always simple formulas. Yes, some products maybe itself not the most simple one, but it's one formula and not too much together. And here you really see, um, while it's all complex, or looks complex, it's step by step trying to be very simple what it does. And if you then look at the model, you can always understand, okay, I like also these highlighting features. If you go into a cell, it shows what is taken from where. Here's a bigger liability section. That's a bit of a side element here for this analysis. But otherwise, you're then starting to your monthly, quarterly, and yearly financial statements. Again, we have the same timing and flags here. We then have here more details on certain counters, months, and for example, here half-yearly counter to allow us to potentially group into half-yearly. And we have then the waterfall that really starts from what is my revenue, what are my costs, what are my interests, and how I end up with my dividends, taxes, cash balance, and then also the P&L and the balance sheet. So and this more or less is then replicated on a quarterly basis, where we see it's a sum of my monthly, using some flags and helping lines to just summarize this in a quarterly basis or an annually basis. Of course, annually, usually you do calendar years. Sometimes maybe a quarterly can be also adjusted to a potential quarterly debt service or calendar quarter. That's there's no right and wrong. And in the end, we are then moving into consolidating that in an executive summary, similar to what you have seen on the slides. This is quite high level, simple. There could be much more detail or another page, but it gives at least a first impression of the model in itself. So just wanted to showcase some live examples of hopefully what we tried to cover in our previous section. Hey, I will now move back to the presentation and switching again. Okay, I hope you see my screen and we can move on. Now we're diving a bit more into the financial, let me see, the financial structure. So this was a slide shown previously. There are the debt, equity, and other instruments with all the details that are then very project specific, but key parts are here where we look at the debt service cover ratio, and to calculate and to optimize. And that's something, as I said, that might be require external support then, or together with the banks to move to a final financial structure. Um, but I want to dive in a bit on the concept of sculpting, because that's quite a um, usual concept to align your CFETs, which maybe are very steady in renewable energy, because you have your generation that should not fluctuate too much, but there could be seasonality parts. When you model a hydro, maybe you have quite big seasonality within a year. Of course, also solar has seasonality between winter and summer. We're not talking here about an hourly model. We're always talking here about monthly and quarterly debt service, but there could be still seasonality. And yes, there are some degradation and other parts or indexation of your PPA that makes maybe the revenue and the CFETs a bit, yeah, not so smooth. And the question is to still see that we align the debt service. And one flexibility we have is determining the repayment portion. The interests are more or less automatically calculated through how much loan is outstanding, what is the interest rate for that period, and then the interests are determined. But the repayment amount can be then made flexible to achieve a debt service cover ratio, a flat one. So that's therefore what we call a sculpted repayment profile. And it's really focusing on what is my minimum debt service I want to achieve, how many years I have to repay, what is my flexibility there, and what is my gearing, and that results into kind of a debt capacity. Yeah, the bank says my maximum debt service cover ratio or my minimum is that, and my maximum tenor is this. Then it determines also a bit, okay, can this $70 million project get a $50 million loan, or 45 or 55? How much debt actually the project can take according to the structural parameters the lenders would require. And in order to achieve this sculpted profile, we again need our CFETs, and then we need to calculate what is my repayment profile to achieve, for example, a flat profile, a debt service reserve, debt service cover ratio profile. And when we're coming into some complexity that you want to freeze your debt, that's meaning you want maybe a little macro that just says, okay, I've calculated now the optimal repayment profile, but I want to now hard code it, because maybe now I want to check on scenarios and I don't want that the repayment profile is changing. So this could be an element. But here we are already a bit into the more details of financial structuring, and just wanted to touch on these points on a very high level. So the repayment here then per period can be calculated. What is my CFETs? How much do I have to pay in interest with a cover ratio, and then divided by the cover ratio? That gives me what is my repayment for this period, and this needs to be then repeated throughout. And the result hopefully is something like this, where yeah, you have a flat profile. So just also checking in the chat. Yeah, okay. Another element is then the scenario and sensitivity analysis, and that's also key. Of course, you build your base case or your equity case, how you as a sponsor and developer see the project, but for example, banks or especially have their requirements for downsides. A key part is the P90 and P50 concept, meaning you're on your production, energy production, what is the P50, the estimated average? What is your P90, which says, okay, in 9 out of 10 cases, the production should be better than this value, and only in 1 out of 10 cases, the production should be worse. So this is some banks using P90 for their banking case, some P50 that's subject to the technology, the country, and so forth. But you want to create these multiple cases, and we have touched on this scenario manager, where you can store these sets of assumptions, because you don't want maybe one case has 15 different parameters. You don't want to manually always change these to get to a case. You want to store these and switch, and then using these set of parameters in one go with one switch between the different cases. And therefore, the scenario manager allows you to create these, to store these scenarios, and change it with one click. And then also you can use this to switch between the scenarios and creating, for example, a scenario table that copies or summarizes the key outputs and key parameters for each scenario. What is my IRR in this case? What is my minimum debt service in this case, in that case? And at some point, you could have kind of also tornado chart where you look at a certain figure, an IRR figure, for example, to say if I change my PPA revenue by 5%, then my IRR goes in this direction or this direction. If I change my OPEX by 5%, the sensitivity is in this direction, this direction. For a tornado chart, it's always good to have the same movement of your parameters. So you're, for example, changing all inputs by 5% plus and 5% minus, and then the different inputs can be ranked on their sensitivity on your IRR, for example. And here we have just a kind of a high-level scenario manager structure, meaning you have a live case, which you want to then be able to change. You have your scenarios and your more or less inputs, which are linked to that scenario manager. And you have your different cases where you say, for example, here technology, capacity, factor, or construction timeline. As I said, it's a template. Usually, when you build a project, you're not switching between technology because you're building one plant and you know the technology and certain parameters you don't want to always change. The scenario manager is really for scenarios which you want to flip between the cases, and that doesn't mean therefore all scenarios need to be part of the scenario manager. And then here, this column more or less picks always the relevant selected set of parameters and then translates it to the rest of the model. And meaning these are the live active scenario inputs, and that then they usually go to the input sheet, and from the input sheet they go usually then back into a calculation. What you see that the formula can be designed like, if there's no value here, always take the base case. That makes it easier to read because you then can focus on the differences, and don't need to replicate all of this. So that's a little tip here. And here again, that just shows how the flow of these parameters are working. You select a scenario, you then take the relevant value into this column, you then move it into your calculation or the input sheet, and from there it moves further down the calculation. Another element which we have touched on in the live model template is the concept of these sums, which are very important, and potentially an analysis. What was my hard-coded value, or you can also say base case, which you can always reset with a click of a button. And then you immediately see the difference. And for example, here you can therefore quite easily see what happens if my PPA reduces by 10%. So you change your PPA inputs by 10%, so the scenario manager or your inputs, and then you want to, first of all, see if the model does what you want. And if you have changed your PPA by 10%, you want to see a minus 10% there. If there's not a minus 10%, you have to investigate if that's still right. And then, of course, you see what does it do to your EBITDA. The tax are reducing because you make less profit, so that's That's fine. What is the CFEDs doing and what is maybe doing to the interest rates or not? Here we have some higher interest rates because maybe there's some flexible repayment schedule modeled. And I think that's a bit leading us to the end of the presentation, to just allow questions. And therefore, I'm happy to look at the Q&A chat. Happy to answer questions and also open the mic if you would like to ask a question verbally. So first of all, thank you so much for your time so far, and looking forward to now answer your question. I see already one. I think we tried to answer the majority of the questions during the webinar, but there's one question regarding if we can build it, you have to build it from scratch, or if you can use a template. I think it's fully fine to start from a template because then there is already a lot of work and ideas and structures, and hopefully it's a good template that gives you a head start. And especially if you have not built yet financial models, it gives you a good anchor and a starting point. And then hopefully with some of the recommendations and lessons learned in this webinar allows you to step by step enhance the model and refine and add more details as required. Of course, these template models are difficult to get, to be honest. It's a highly intellectual property, usually of consultants, banks, or advisors. And I'm therefore unfortunately not aware if there are templates in the open in the public domain via the internet. I think so, but I have not had a look yet. We might see if we can find something and recommend something, but I don't have something at hand right now. We as Greenco at the moment don't have a template ready for sharing. It doesn't mean that it maybe at some point we will make this available as an additional service, but that requires a bit more work also for us. And therefore, it's not something I would promise would like to promise in the short term. But definitely watch the space. Maybe there will be something coming in the next year or so, but it's not something that we can do very short term. Um, but I see, yes, the US National Renewable Energy Lab provides a template. I think that's a potentially very good start. And hopefully, when you have a look, you will see that some or all of my recommendations are also there, but I guess it's a decent one. So thanks for that, for the audience.
Yep. Great. Thanks, Johannes. I think we have a hand.
Mhm.
Be Volker. Just up. Volker, hi. Your mic is open.
I think you have to unmute yourself potentially, but then you should be able to speak.
Yeah.
Yeah, you have to yeah, no,
Hi,
perfect.
it worked. Sorry, guys. I wasn't meaning to raise a hand, so sorry for wasting your time. I wasn't watching where my mouse was, so no question
No,
from me. But thanks anyway. Great presentation, by the way. So thanks.
Sure, no
no problem.
worries.
Thank you. Yeah, we hope that was helpful. We stayed on a very high level, but trying to give some insights on some key best practices, helping maybe you to spot also what is a good financial model or not, maybe how to navigate a good financial model. And yeah, I would say thank you so much for your time, and we will upload this recording. And thanks for your interest. Jay, over to you.
Great. Thanks, Johannes. And thanks everyone again for joining us today. Just struggling with my camera. Yes, thanks everyone for joining, and uh, we will be hosting another webinar session next month, and we will share the details with you as they come along. And again, the recording will be made available to you on our YouTube channel, so you'll be able to review that. And of course, if you have any follow-up questions or any clarification that you would like, you can always send us an email and we'll be able to respond to you. But thank you so much for making the time, and hopefully you'll be able to join us again for our next one, which will be disclosed to you. I believe the topic will be around BESS. Thank you once again, and thank you, Hannes, for the lovely presentation. And yeah, that brings us to the end of our webinar. Thank you.